The following is a presentation that I've used for over 35 years to better explain how retirement plans are constructed. I've used this when I first visited a business owner to help them better decide which plan is a best fit for them, their employees, and their business. To establish a retirement plan, you must first have a company to sponsor the plan, which is a taxable entity. The company can be a sole proprietorship, partnership, corporation, or limited liability partnership or corporation. There is an exception. You can have an S corporation sponsor a plan, but you cannot use the pass-through profits to base the contributions to fund the plan. You must have either W-2 or 1099 wages to be able to contribute to the plan. Tax-exempt entities can sponsor a retirement plan as well. Certain tax-exempts have retirement plans specifically available to them.
Excellent.
The sponsoring company establishes a tax-sheltered trust. It is a separate entity with a separate tax ID number or trust ID number and will file its own tax return specific to the retirement trust. A Form 5500 and associated schedules will be used. We also refer to the trust as a tax-qualified plan or retirement plan. The trust is assigned one or more trustees who govern the plan's operations. There is also a plan administrator who handles the day-to-day functions of the trust. Some of these functions are farmed out to contract trustees and administrators or third-party administrators. Third-party administrators are commonly referred to as TPAs. The trustee and the administrator can be one and the same. The trust is established with a plan document and a trust document that dictates its operation. The documents contain the appropriate language required by the Internal Revenue Code and the Department of Labor. The trust is assigned one or more trustees who govern the plan's operation. The tax-qualified retirement plan has some special features. The earnings on the investments earn tax-deferred until funds are distributed to the participant. The tax-qualified retirement plan is protected from creditors. If the sponsoring company files bankruptcy, the creditors of the sponsoring company cannot seize the assets of the trust. If the trustee, administrator, or employee participant files for bankruptcy, the creditors of that person cannot seize the assets of the trust. The same protections are there in the event of a lawsuit to the company or any other people involved with the trust. The trustee can direct the investments of the trust solely, which is commonly referred to as an annual valuation plan. This was the norm prior to the advent of 401k plans. Or the employee participant can self-direct the investments of their account, which is referred to as a self-directed plan, or daily valuation, which is now the common 401k plan. The trust can also allow loans. When allowed, participants can borrow up to 50% of their vested account balance, up to a maximum of $50,000. The loan payment must be made through a salary deduction. Also, the loan must be paid back within 5 years unless the loan is to be used to purchase a home. Not all plans permit loans, nor are they required to. The trustee and the plan administrator decide whether loans will be allowed when the plan is initially established. Whether the trustee directs the investments or the participant directs the investments, there is an accounting of the trust and there are individual participant accounts. If you peel back the layers, you will find that there are multiple accounts for each participant. There can be accounts where the employee salary deferrals are deposited, accounts for employer matching contributions, accounts for the employer's discretionary contributions, accounts for forfeitures, of which we will explain later. IRA accounts and Roth IRA accounts can also be held in a tax-qualified plan as a sub-account. Yet, at the end of the day, the funds are in reality lumped together into one bucket. How do you deposit money into the trust? Employee participants defer money from their paycheck into the plan pre-tax. The employer can match the employee's salary deferrals. The employer can contribute on a discretionary basis. In many cases, this is considered a contribution of profits or profit sharing. The employer may have to make a top-heavy contribution that is 100% vested. Top-heavy contributions are required when the highly compensated employees account for more than 60% of the assets in the trust. Highly compensated employees are owners or shareholders in the business and or employees with incomes over $120,000 annually. There is also a super top-heavy designation of a plan where 90% of the assets are owned by the highly compensated employees and or owners of the firm. Lastly, IRA and 401k rollovers can be contributed to the plan. All of these are set up as separate participant accounts for record-keeping purposes. How do I get money out of the plan? Death. If a participant dies, the named beneficiary receives the account balance. The distribution is taxable unless it is rolled over to a beneficiary IRA. If the account is not rolled over, it will be subject to ordinary income tax. Disability. If a participant is disabled, the participant can receive the account balance without penalty, but the funds are taxable. Remember, all contributions are made pre-tax and you will have to pay the taxman someday in the future. Termination. If a participant terminates employment or they are terminated by the employer, the participant will be able to distribute their account and either spend the funds or roll the funds over to an IRA. Retirement. The ultimate goal is retirement. Many times you will see normal retirement age of 65 written in the plan. This is not a hard set age that you must work until you receive your benefits or your participant account balance. It is an age that is referred to in the plan document for a number of reasons. If you retire earlier than age 65, you may have to wait a little longer before you may receive your benefits. This varies from plan to plan. As long as you are older than age 59 and a half, you may receive your account balance and any portion you spend will incur income tax only. There will not be a 10% penalty in addition to the income tax. If you desire to retire early, there is usually a provision to do so. In most cases, the early retirement age is set at age 55. If you wish to retire early and you do not want any part of your benefits to be subject to penalty, you can do so under the tax code 72T. As long as you receive distributions that are considered substantially equal periodic payments, you will not be penalized. You will only owe income tax on the distribution. The distributions are calculated much like the annuity payments over your life expectancy. There are many calculators online that will help you determine whether or not it is feasible for you to retire early. Divorce. Retirement benefits are community property. The trustee and/or custodian of the plan must be told how to split up the participant account. The document that is accepted is a QUADRO, Qualified Uniform Domestic Relations Order. In most cases, an attorney draws this document up for the participant. I have seen where a divorcing couple grabbed a template online and created their own. If a couple can agree, this is the most inexpensive way to go. I've had several clients in the past do so successfully. As an employer, you can restrict the employee's entry to the plan. You cannot, though, pick and choose who you want to participate. The purpose of exclusions and restrictions is to prevent a revolving door of employees coming and going, contributing and distributing their benefits, and creating much unnecessary paperwork for the employer and/or your staff. The eligibility provisions can be used as a tool to keep your employees tied to the firm long term. Employees younger than age 21 can be excluded from the plan. In many cases, the younger employees are not permanent and move from job to job quite often. The exclusion helps cut down on paperwork. Any employee that works for the company under age 21 will gain years of service towards vesting. We'll explain vesting later. Another exclusion is to require the employee to work a minimum of 1,000 hours before they can participate in the plan. This helps eliminate any part-time employees. 1,000 hours per year equals approximately 20 hours per week. The 1,000 hours of service to the employer is used to determine years of vesting in the plan. Lastly, we can exclude union employees. If you have a company that employs union employees, the union employees have most likely negotiated their union benefits separate from the rank-and-file non-union employees and management employees. Therefore, they can be excluded from the plan. Discrimination. There are rules that allow the employer to discriminate. One way is by integrating the plan with Social Security. Social Security in itself discriminates against the highly compensated. This can be reversed to some extent over time with a simple formula that increases the employer contributions each year by taking in consideration the Social Security tax rate. Age. Plan contributions can be weighted heavier to the benefit of the older employees by taking in consideration the employee's age. Older employees will receive a higher contribution as a percentage of their income versus the younger employees. This is allowed due to older employees not having as much time to accumulate funds before retirement, where the younger employees have more time. There are many different formulas to accomplish age weighting. Depending upon the employer and the number of employees, one formula may be better than another. For larger firms with hundreds and thousands of employees, benefits can be adjusted by job classification. Management will many times receive benefits different than the rank-and-file employees. We mentioned the term vesting earlier. Vesting means ownership. Many employers wish to tie the employees to the firm for a longer period of time. An incentive to stay with the firm is to create a vesting schedule in the plan. This is where each year a portion of the employer contribution is owned by the participant. There are only a couple schedules now. The 6-year vesting schedule is the longest allowable. When I first started in the business, it was not unheard of to see a vesting schedule as long as 15 and 20 years. To do the math while using the 6-year vesting schedule as an example, and assuming a participant had $2,000 in their employer discretionary account at the time of termination, and also the participant had been with the firm for 3 years, the participant would only be able to receive $800 of the employer discretionary contribution. The remaining $1,200 is forfeited. We call the forfeited amount forfeitures. The forfeitures are either used to reduce future contributions or reallocated to the participants who stay with the firm, thus creating another incentive for employees to stay. Now that you have a basic understanding of how plans can be constructed, we would like to explain the different types of plans. All of my earlier discussion does not apply to traditional and Roth IRAs, but we need to understand the features of an IRA before we progress to tax-qualified plans. The most basic individual retirement plan is the traditional IRA. Contributions to traditional IRAs are tax deductible, and the growth of the investment is tax deferred. The IRA is protected from creditors, meaning if you are sued, no one can take your retirement account away from you. The current maximum contribution limit is $5,500, and for those of you who are older than age 50, you can contribute an additional $1,000 as a catch-up contribution. There is no tax return to file, and if you are a business owner, you do not have to include your employees. The contribution deadline is April 15th of the year following the year you wish to receive the deduction. Another individual retirement plan is the Roth IRA. The Roth IRA has the same provisions of the traditional IRA, except there is no tax deduction up front, but the investments in the Roth IRA earn tax-free. The contribution deadline is April 15th of the year following the year you wish to receive the deduction. The SEP IRA is built for small businesses and is a great low-cost plan. The employer contributes up to 25% of his or her adjusted gross income, if you are self-employed or a sole proprietor, to a maximum dollar amount of $54,000. The employer may exclude employees with less than 2 years of service and earn less than $450 of income. The employer may also exclude non-resident aliens and union employees. The employees are 100% vested in all contributions unless the employer decides on a 3-year waiting period. The plan can be established after the end of the calendar year for deduction and planning purposes. There is not a tax filing, and there are no expensive plan documents. This plan is perfect for a one-person business. The Simple IRA is a small company's version of a 401k. It looks and quacks like a 401k, but has a number of features that make it simple for the employer. With a Simple IRA, there is no percentage maximum contribution, which means you can contribute up to 100% of your pay to a maximum of $12,500. If the employer wants to contribute more than $12,500 and is married, the employer can pay their spouse $12,500 and contribute 100% of their paycheck, bringing a total contribution between the spouses of $25,000. There's also a $3,000 catch-up provision for employees over the age of 50. The employer decides upon a 1 or 2 year waiting period, and the employees are 100% vested immediately in the employer match. The employer must match either 2 or 3% of the employee's pay. If the 2% match is chosen, all eligible employees are matched whether the employee contributes or not. If the 3% match is chosen, only the employees who participate in the plan are matched. Employees who make less than $5,000 in income can be excluded. The plan must be established by October 1st of the year in which the salary reduction is made. You cannot wait until the following year up to April 15th like other IRA plans. The reason for this is to show a period of salary reductions. Lastly, there is no tax filing required and there is no document required. It is a great plan for small businesses with less than 100 employees. The profit sharing plan is your most basic tax qualified plan. Like the SEP IRA, you are able to contribute up to 25% of your earned income to a maximum of $54,000. The term profit sharing is a misnomer. It does not necessarily mean the employees are sharing in the profits of the firm. The employer can establish eligibility requirements. 1 year of service is attained once the employee has worked 1,000 hours. The 1,000 hour requirement determines whether an employee is part-time. It works out to be about 20 hours per week. The plan can discriminate based upon the Social Security wage base. Social Security discriminates against the higher paid and can be offset slightly over time with a profit-sharing plan. The plan can be written to discriminate by age and income. This allows the employer to benefit more. Some of you may be offended by that, but if the employer does not benefit, there will be less likely any contribution to any plan. The employer is funding 100% of the money to the profit sharing plan, and he or she should get a fair share of the benefit. There can also be a vesting schedule of up to 6 years. Vesting means employee ownership of the contributions. The employer typically wants to use the plan as another tool for employee retention. The vesting schedule gives the employee the incentive to stay. There are expenses to the employer for establishing the plan. There is a legal document to establish the plan and trust. Also, a tax return must be filed each year to the IRS. A third-party administrator, TPA, is usually engaged to take care of maintaining the plan document, the annual Form 5500 tax filing, and providing reports to the participants. The money purchase pension plan is not as popular as it used to be. Back in the day, for business owners whose income fluctuated from year to year, we would establish a profit sharing plan and a money purchase pension plan together. The money purchase pension plan contributions are fixed from 1 to 25%, meaning the employer commits to the fixed contribution every year. Therefore, we would establish a 10% fixed contribution to a money purchase pension plan and layer on a profit sharing plan, which at the time had a flexible 0 to 15% contribution. Over the years, the tax law changed to allow profit sharing plans a 0 to 25% contribution. Thus, the money purchase pension plan became unnecessary. The money purchase pension plan is still used for governmental and charitable entities where the budget is set for a fixed annual contribution. The 401k profit sharing plan is what everybody is familiar with today. With a 401k, the maximum annual contribution is 0 to 25% of pay. The employee can defer up to $18,000, and if the employee is over the age of 50, an additional $6,000 catch-up contribution can be made. The 401k has the same eligibility requirements of up to 2 years of employment and 1,000 hours of service. Just like the profit sharing plan, the employer discretionary contribution can be integrated with Social Security, or the plan can discriminate by age, income, and/or job classification. The same vesting schedules can be established, and there's a plan document and an annual tax filing. The biggest benefit of a 401k plan is the ability for the employees to self-direct their investment choices. Though this option took my industry by storm over the last couple of decades, it did and still does add an additional layer of expense. The defined benefit pension plan is the true pension plan. All the other retirement plans I've spoke of thus far are defined contribution plans. In a defined contribution plan, we are defining and calculating the annual contribution up front. What the future benefit will be is unknown. With a defined benefit pension plan, we are funding for a predetermined monthly benefit. We are defining the future benefit to be received. This plan is great for small business owners who have waited too long to save any money for retirement and want to contribute a large sum of money over a short period of time and/or want a large tax deduction. The defined benefit pension plan also is great for large profitable companies that want to provide a great long-term benefit for their employees. The defined benefit plan is a more complicated plan and more expensive. The employer must engage a licensed actuary who is a highly skilled mathematician. The actuary signs the Schedule B certifying his calculations. The Schedule B is attached to the annual 5500 tax filing. In very simple terms, this is how a defined benefit plan works. Today you have $0 in the plan. In the future, say 20 years, you will have a lump sum of $1.4 million. This lump sum will pay you $110,873 per year for the rest of your life. Here we have defined the benefit to be paid and to be accumulated for. To get there, the actuary calculates an initial funding contribution of $75,000. Each year moving forward, you will contribute approximately $75,000. This payment will fluctuate from year to year based upon the rate of return on the investments, your age, your employee's age if you have employees, your annual pay, and the assumed interest rate used by the actuary. The actuary uses an interest rate of 4 to 6%. Therefore, it is not necessary to try to outperform the market nor try to attain stellar rates of return. In the event you made a high rate of return in 1 year, say 18%, your following year's contribution will be lower. In this case, we show $68,000. If part of your goal is to shelter a large sum of money, earning a high rate of return will defeat the purpose of that goal. If, on the other hand, you take too much risk and create a loss, you will fund more than the $75,000 the following year. Therefore, it is better to take a conservative approach and earn modest returns with less risk and create more certainty for yourself. It is funny, over the last 35 years that I have been in business, the IRS and the Department of Labor have been changing and rearranging the laws regarding retirement plans to prevent discrimination against the employees. At one time, they decided there was to be a gauntlet of tests to ensure the employees were not discriminated against. If the plan passed these tests, it was determined to be qualified upon the rules of the IRS. Yet the rules caused a contradiction that defeated the legislators' efforts to restrain discrimination within tax-qualified retirement plans. We are now able to discriminate in favor of the employer and or highly compensated. Also, we can be much more creative than ever and are able to mold a plan that is suitable to the employer's needs. This is done with various discrimination formulas such as Social Security discrimination, which has been around for many decades, safe harbor formulas, new comparability plan formulas, and super integrated retirement plans. More recently, the cash balance plan has been created. It combines the features of a defined benefit pension plan and the salary deferral feature of a 401k plan. This way, the employees participate in building a retirement for their future. The employer provides a match and can also make a profit-sharing contribution if so elected. Where the employer owners are now able to fund their pension in a much more robust manner, where in the past they were restricted by formulas that weighed the contributions in the employee's favor. We hope you have found this presentation helpful, and we look forward to assisting you with your retirement benefits soon. I am Corey Calloway of Calloway Financial Services, and remember, before you give it away, call Calloway.